Hey traders, welcome back to the channel. This video today is going to be about put credit spread and how to set one up. We're first going to go over what it is and why you want to do it and the risks and rewards and things like that, and then we'll go through some examples on my Robinhood account. So let's jump in. Now, what is a call credit spread? This is a bearish strategy. So what it is, it's when you sell a call out of the money or above the current strike price. And then what you do is you buy a call further out of the money or higher in price. And I'll show you an example in a minute. And again, this is a bearish strategy. You want to use this when you think the market is going to go down or be flat. And what this does is limits the risk, but it also comes at the cost of limiting your rewards. And because this limits your risk, it's a great strategy for small accounts. Now, when you sell a call, you want the stock to go down. As the buyer of a call, you want the stock to go up. So for example, if the stock is at 50 and you have an option at 50 and the stock goes up to 60, well, you could buy them at 50 and they'd be worth 60, so you would already be in the money. Let's look at an example on my Robinhood, and this is by no means a recommendation that you should take this trade. In fact, you probably shouldn't. You should do your own research on your own stocks. This is just an example. And I'm not even going to go through and take this trade, but I just want to show it as an example here on my Robinhood. So I'll click, I'm looking at this ProShares TQQQ. I click Trade Options. And then I want to pick an expiration. I want to go maybe out like almost 2 weeks here. And the first thing you want to do is sell a call. And so you want to choose a strike price where you think the stock is going to be remain below when you're selling this call. So I'm going to go here at the $60 strike price and select that. And for that, I should collect a credit of $2.56 per share times 100 shares per contract is $256. Now then what you want to do is go to buy a call, and you want to go higher in price. So let's just go $1 higher at 61 and select that. And this means I'll have to pay $2.17 after collecting the $2.56. So I'm going to collect the difference as premium, which is the 39 cents per share or $39 here. And then you can see the profit and loss graph here. If the price goes down, again, this is a bearish strategy, then I can make the full profit after it reaches 60 or goes below 60 here. But if it's in between, I start to lose money, and the break even is $60.50, which is right between 60 and 61. And then once it gets to 61, then I lose my max loss. Now, if I didn't have this long position, then I would collect a higher premium. I'd get the full $256, but then my risk goes way up to an unlimited amount here. So if the stock went way up past 62.56, then I'd be at risk for more loss than I would if I had bought this call at 61. So that's kind of the benefit of doing a call credit spread, is that you limit your risk, but you also limit your reward. So what you're doing is taking some of this $2.56 and you're paying for protection here. So again, when you sell a call, you want the stock price to be going down. And when you buy a call, you want the stock price to go up. So for example, if I don't have this here, let's just say I sold this call at the $60 strike price and I collected $2.56 for that. So now if the price goes above 60, let's say it goes to 70, well, then I'd be obligated to sell. Someone who bought this call has the right, but not the obligation, to exercise that right. I'd be forced to sell at 60. They could buy it from me at 60. And if it was up at 70, then they could sell them at 70 and make a profit. Likewise, if the price went down to 50, let's say, there's no way that the buyer is going to want to exercise their right. They're not going to want to sell it to me at 50 when it's worth 60. They could sell it to somebody else for 60. So that option ends up expiring worthless. And if you're the seller of this option, then you collect the full $256 and you don't have to buy the shares. And on the other hand, when you buy a call, you want the stock price to go up. So looking at this, if I bought that call at the $61, and let's say the stock price ends up going to $71, then I've got the option or the right to buy these shares at 61 and then I'll have shares that are worth 71. So I would definitely exercise that right if the stock went above the strike price. So that makes this a great strategy for growing a small account because your risk is capped. You do cap your profit, but your risk is much more reduced. So really, we're just risking $50 here for a max profit of 50. It's just a 1-to-1. And if you could do this over and over again, or if you wanted to trade 4 contracts like this at the same time, that could be $200. If you did that every day, you'd have a great side hustle going on. Let's take a look at a visualization of what this looks like on this site called Options Strat. So I'm going to build, this is the bear call spread, and I'm going to put in my stock, which is T. And the expiration is March 22nd, I believe. And we are selling a call at 60, and we're buying a call at 61. So we can see here the max loss again is $50.50, net credit of 49. So we can see if the stock stays right at $60, we got to wait all the way till expiration before we receive the max amount of profit, which is $50. If it starts to go above that, then we realize our max loss of $50 if it goes beyond the 61.50, which is our long strike. So if the price goes way down to like 54, we could start collecting profit, in the next day. Let's say we want to close this out midweek, we could get $47 for that on the 18th and not have to wait all the way till expiration. There's different things involved, like implied volatility changes the equation quite a bit, and the range that you want to look at for the price spreads. Looking at the $60 sell that we did here, the implied volatility is 56.42 right now, so we could actually plug that in, 56.42 or so, and we can see it changes things a little bit. We could start collecting almost the full profit if the price drops down just a little bit less here. So again, this is a bearish strategy. That's why you're seeing the green down below. So we're looking at the price, we're expecting it to drop. And one thing I look at is I look at my trading view, and I try to see if the stock is about to fall. So typically I've got the Bollinger Bands is what I use, and there's a standard deviation, and things when they get above the standard deviation on top here, they tend to drop back down. You can see here, up here it got above, then it dropped back down, then it went down to the bottom, which is the standard deviation the other way, came back up, then it went back down, outside the standard deviation a little bit, then it went back up. And so it's kind of like a marker right now. It seems like it's more likely than not. Again, we don't know what it's going to do, but you can look for trends and start to put the probabilities in your favor. So I'm thinking right now, this is the daily chart, that we're going to start seeing like a bearish trend here. That's kind of why I'm going with the call credit spread here. So now going back to this options strat site, I also wanted to show you the graph. You can click here and get the graph and get a better visual of what things will look like as the price starts to drop, how much profit you'll make, and when you start making your max profit, and likewise if the price starts to climb, when you'd incur your max loss. And so overall, this is a great strategy for when you think it's going to be a bearish market. These kind of spreads help you reduce your risk. You do reduce your reward somewhat, but it's a small price to pay sometimes for reducing your risk. And it's a great way to grow your small account because you don't need a lot of capital with these spreads. Like the capital required as collateral here is just $100. It's the difference between the $60 and the $61 prices, which is times 100 would be $100. That's the most amount of collateral you'd have to put up. So I hope you liked this video, got some good value out of it. If you did, please hit the like button and make sure to subscribe so you can see all the other videos I've got coming out about selling options for income. And we'll see you on the next one. Thanks a lot. Bye.